So we're going to work on the allowance for uncollectible accounts and how to reserve for bad debts. Let's assume you have two clients, Badger and Lizard, and they have the same activity for the period. They both had $500,000 in sales, $400,000 of which were on account credit sales, and the rest were cash. At year end, they both had $74,000 of the sales that were not yet collected. That would be AR, right? Accounts identified to be written off during the year for $6,900. So of the $400,000 sold on account, this many they don't believe they're going to collect. In the beginning, in the allowance for bad debts or the allowance for undoubtful accounts or uncollectible accounts, those are all three different terms for the same account. The balance in this allowance account was $3,000, beginning balance. They have two different policies. Badger's policy is percent of sales. Lizard's policy is percent of receivables. So let's use the two different methods and see how it turns out. So for Badger, let's look at the T account for uncollectible accounts. And we'll get to Lizard in a minute. So the beginning balance was $3,000. It's a credit balance because it's a contra account to accounts receivable. It means it has the opposite natural balance as the parent account, since it's the child of the parent, which is accounts receivable account. So it's going to go up by bad debt expense. And how much is bad debt expense for Badger? Badger's policy is 2% of credit sales. So we would do 2% times their credit sales, which in this case is $400,000. So they're going to add $8,000 to the allowance account and record bad debt. So this journal entry would be a debit to bad debt expense and a credit to the allowance for uncollectible accounts. Then the write-offs during the year would go against the allowance account. So that $8,000 that was accrued in to estimate for write-offs, this is part of it. So part of that $8,000 has already come through and had to be written off. But there is some of which that we think will flop into the next period and we'll have to write those off later. So the balance in the account would be the beginning plus what we estimated for this period minus the write-offs. And some of these write-offs here may have been the $3,000 from the prior period that we estimated that we were going to write off this year. So they don't tell us how much of this write-off relates to invoices from a prior period and how much relate to invoices from this period. So this would be the ending balance in the allowance account. So the balance sheet presentation would be accounts receivable, which they said was $74,000, less the allowance account, giving you net realizable value of the difference. So there's your balance sheet presentation. What would go on the income statement? $8,000 of bad debt expense. Alright, let's do Lizard. Lizard also has a $3,000 beginning balance in their allowance account. And since their method is percentage of receivables, their method is to estimate the target ending. So they want the ending balance and allowance to be adequate to cover 6% of what's not yet collected. So what we need is 6% times the amount not yet collected as of year end, 6% of accounts receivable. The write-offs are $6,900 would reduce the allowance account. So the question is, how much is needed? How much bad debt needs to be accrued in here to leave you with that ending balance? Alright, so it would be these two minus what you already had. So we would need bad debt expense of $8,340 in order to get the ending balance to be the target that the policy calls for. So what adjustments do the two clients need to make? They both need to make a debit to bad debt and a credit to the allowance account, but Badger's going to make it for $8,000 and Lizard's going to make it for $8,340. The differences are because the methods go about it slightly differently, but they're both close and they're both an estimate of next year. So there's no telling that either one of these ending balances is going to be the amount that they need for the write-offs that are coming up from this year's sales. They're just estimates, and probably the write-offs next year won't be either of these numbers, but maybe something close to both of them. Which of these methods led to a higher net income? Well, this one had a lower bad debt expense, and so the income would be a little higher for Badger than for Lizard. Are they both correct? They are both correct because both methods are permissible under generally accepted accounting principles. And they're not correct or incorrect because they're different from each other. They're different methods and they're both acceptable, and they should be within a reasonable range of each other.